Welcome to the Contractor Success Forum. Today we are discussing the differences in accounting for construction. And we at the Contractor Success Forum discuss financial strategies for running a more profitable, successful construction business. And in one corner, we have Wade Carpenter and Company CPAs, helping contractors nationwide to become permanently profitable for over 30 years. Wade provides accounting, auditing, bookkeeping, and consulting with tax matters in construction. And in the other corner, we have Stephen Brown. He's providing construction risk control through bonding and insurance. Stephen stays relevant through a career dedicated to solving the needs of his clients and offering solutions that work for his customers. With over $500 million of bonds approved in just the last 5 years, Stephen is poised to help take you to the next level. Stephen is with McDaniel Whitley Bonding and Insurance Agency. And I am Rob Williams, your profit strategist with Iron Gate Entrepreneurial Support Systems. I'm helping drive profits in your business with decades of experience as a contractor myself. So today, guys, Wade, are there any differences between accounting for construction versus other businesses? How could they be different?
Well, absolutely they are. And I'm here to tell you that construction accounting is not taught in school. Basic accounting is taught in school. There's a lot of different methods and there's a lot of different individual quirks from construction that are just not taught in school. So the question came up like, why do you need a construction CPA? A lot of CPAs don't know the rules, quite frankly, from the GAAP standpoint, accounting principles as well as the tax principles. They are different.
Oh, yeah. Stephen, in your bonding experience,
Generally accepted accounting principles for contractors, there's a whole book on it that just about every underwriter, trainee, and agent has read about contracting. And then, from a bonding standpoint, there's percentage of completion accounting methods that are everything. It's the engine that drives our ability to keep your bonds going throughout the year, not just based on what your fiscal year end says, but it's what drives your bond program.
yeah, for so long, I guess I'm old, so I was around this a long time. I guess I didn't understand what GAAP meant because we did our taxes, excuse me, our well, that's what we did. Our accounting, we did it for tax purposes, and we did it the way we wanted to report it. And then the accountants or the guys that would do the stuff to give to Stephen to give to the bonding agency, they would take our books and then do whatever they had to make it GAAP, where it's supposed to be the other way around. So I just didn't really understand what GAAP was for construction. I thought we were all just deciding what the best method that would make the most sense to us. I didn't realize for decades that they had a book that told them how that there was a standard way that everybody needs to be doing this.
And did we make clear GAAP stands for generally accepted accounting practices? Is that right?
Principles, yeah.
Principles, okay.
Yeah.
Yeah, which are good
Generally
practices.
accepted.
And it's not the IRS. I didn't realize that. That's different.
It is different. And believe it or not, there are different hybrid methods for the IRS that are acceptable that are not acceptable for GAAP. And there are some rules for accounting methods for tax purposes that don't follow GAAP either. So, if we're going to talk about accounting methods, you have a accrual method taught in school. To an extent, you have a cash method taught in school. That is it. But what Stephen's looking at is percentage of completion. And there may be some other methods like completed contract we can talk about in a minute. But with cash or accrual, it's very easy to say you could be way far built in advance on your jobs and look really good on a cash basis, but you could be so far underwater on that job that you could be next to being out of business because you're out of work. And the percentage of completion is the reason why the bonding companies want it, because that's a truer picture of where they are.
Before we get too deep in it, let our listeners know, okay, why do we do GAAP? What you were just saying, it's a standardization. Is that right? So people like the banks and Stephen and them can know what they're looking at to compare them to.
It is the standardization for accounting. This is what we're supposed to be following. And I guess I could also say that there are different types of construction that percentage of completion is also not necessarily the accepted method for that. If you got a construction management job, that would be accounted differently from something like this, a typical construction contract where you would do percentage of completion. Something like a developer, or just, we don't talk about on the residential side as much, but a home builder that's doing spec homes, they're essentially doing accounting, or they should be doing accounting based on completed contract method. It's essentially inventory for your costs, and it's a liability for your billings until you complete that job or you sell that house.
Does everybody need to do GAAP? That was my one thing, because I've run into some guys that say, I don't want to go into the commercial. I'm not going to do a bonding job. I got to do all that different accounting stuff that I don't understand. So you can run a business without GAAP if you don't need financing, and if you don't need, well, there's another way to get financing, but if you don't need a big bond, and if you don't need regular, I'm calling it regular financing, that's compared to that, then you don't need to do GAAP. I guess you could put up collateral or something for that. I don't know if the bonding, if you can get bonded without doing GAAP accounting. Yeah, okay, I was wondering about that.
Yeah, you can get by with the banker, and not to knock a bankers, but most of the bankers don't know the difference. You could have report on accrual basis or cash basis or your tax method. Typically, a lot of bankers will look at your tax return, and that's the only way to do it. And
Mhm.
we may have a very different method of accounting for your tax purposes. And it's unfortunate because we're trying to minimize your taxes, but to maximize your financial statement or maximize bonding, we follow GAAP and we do different things to get there.
Yeah, I think this is one of the big hurdles that people have that take the road that I did, that went from residential to the commercial side, and this was one of the intimidating factors of having to go through GAAP and having to make these changes that we didn't even know what the heck we were looking at doing. So it's kind of a big deal, but it's not a big deal. And I don't know how much it changes the business as long as they've got somebody to report it. Now, they can't have their regular bookkeeper probably do GAAP accounting, because most of the people, they're just doing a cash basis set of books that I see, the small guys. And to convert to this, it's probably going to take more than the bookkeeper. It's your cousin in the back that needed some work or something that's doing that. So your cousin may be smart, but you need somebody with experience with GAAP to do that. Anyway, I hope I'm not getting off of the topic, but on the differences of that, some of the differences to me are the intimidation factors of switching this, and why do you even need it?
Well, number one, the distortion factor. If you are on a accrual basis, you could bill a whole bunch up front, but you may not be able to collect that. You may have a bunch of retainage or whatever, but the reason percentage of completion kind of gets that out. If you're way far build ahead, that's what we want to do. You may not have earned that much yet. So you actually could be having a liability, and it brings that revenue back to a point of what have you actually earned based on the percentage that you've gotten done. Conversely, you could be so far underbilled, and Stephen and his underwriters are probably looking at how much are you overbilled or underbilled as a percentage of different things on your balance sheet or your revenue. But a lot of the things that we're doing on a percentage of completion basis are not intuitive. If I had a accrual basis or a cash basis contractor and I increase my cost, what does that do to my profit? It brings our profit down. Now, on percentage of completion, if we increase, this doesn't make sense to people unless they really think about it. If you increase costs on jobs that you are making profit on, you're increasing your percentage of completion. You're also going to be bumping up your profit. So a lot of people try to avoid getting their bills in or whatever. Well, number one, they're distorting the picture, but number two, you're shooting yourself in the foot with percentage of completion accounting. Does that make sense? Because we're going to make an adjustment for whether you're over or under billed based on whatever percentage and your revenue. based on whatever that percentage completion you actually are.
Do you
We've
want to
actually,
define the over or under billing in there? Maybe it gets difficult. I know on some of these tests that Steve and I were in some classes, just the concept of over and under billing. I got it until they started asking me these really detailed questions on these tests and how it affected things.
let's just take some easy example. Let's say we had $100,000 cost. We're expecting a $200,000 revenue. The whole contract's going to be $200,000. We got $50,000 of costs in on that job. So 50,000 of the 100,000 we're expecting in cost, that's going to be 50% of revenue. Well, number one, going back to what I said before, if we actually had some costs like $10,000 more of cost, that would be $60,000 worth of revenue, or 60%. And 60% of 200,000 would be $120,000 of revenue earned. We may have billed 140,000. So in that case, we would be overbilled by $20,000. We've earned revenue up to 120,000. I'm not trying to get too deep in the woods, but does that kind of make sense to you guys?
Yeah, it does, but it definitely gets your head spinning sometimes because you've got the cost. And when you're in the residential world, you just have a cost. When the cost goes up, your billing in your contract was the same,
Right.
where the cost and the billing, the revenue is tied to your cost and you get these percents. That's the thing that is not intuitive for the guys coming from the residential. Because if you got $100,000 addition you're doing and you spend 60,000 this month instead of 50, well, you're just $10,000 over budget. It didn't change your billing. It didn't change anything like that. And in the commercial, you've got to realize when that cost is going up, and what do you do with that extra 10 that you're over budget? Going ahead and reporting that now is over budget, under budget, under billing, over billing, and then I guess you're trying to line that back up with what your contract is.
We had a whole podcast on over and under billings. I remember under billings show up as an asset because you haven't billed out, but you've incurred cost. So that's an asset. But over billings is the work that you haven't performed. The costs haven't been accounted for yet.
And that's one of the things. I know we could talk about cash flow all day long too, but encouraging your subs or your material suppliers to get their bills in before you do your billing. A lot of people say, I don't want to pay that yet. Well, but if you get that bill in, whether you paid it or not, a lot of people don't realize how much cost they've actually got in that job. And then they're sitting on expenses they've already incurred and work they've already done. So it's counterintuitive, but it definitely helps bump up the profit as long as
Oh,
you got a profitable job. If you got a negative job, well, you may want to take a lost job. You may want to take a little different approach to it. But
right. Yeah, that was my example a minute ago. Yeah, that gets a little difficult. So,
but
well, good.
one of the things that I know we also wanted to talk about this time is we can't really do percentage of completion or a completed contract if we don't have job costing.
Great
I
point.
know that's one of our hot topics that we talk about, but number one, job costing is not taught in schools. So maybe more advanced manufacturing type things where we're costing out. But I just had this conversation with a multifamily general contractor last week that, basically has exploded in growth, but they have no job costing and they can't get it in their heads that they got to do this. Number one, in school they teach you, well, okay, so you got an expense that goes to materials, but not, well, it goes to materials and we're going to cost this to this job. And usually when I price out like doing bookkeeping services for construction contractors, we kind of put it in two different buckets. Do we want to do like basic job costing or detailed job costing? Basic job costing would say, I want to put this cost for materials into just that chart of accounts. Detailed job costing is going to say like this, say it was a subcontractor. Well, basic would say we're going to put it to subcontract expense, but detail would say, well, we had a electrical subcontractor, HVAC subcontractor. The phases and cost codes is what I refer to it as. Getting down to a little more, we don't have to get too deep in the details, but if you got a contractor and you've never done this, maybe you need to start with the 5 categories: materials, labor, subs, equipment, and other. If you can do that, that's a great start. And, if you make it too complicated from the start, sometimes it's just tough to do. But, I have that multifamily never been bonded, and now they're being approached by a bonding company. They got a job, they've got a bond, and they want us to create a WIP report with nothing,
Hmm.
so with no job costing. And it's tough.
You don't know where you are in the middle of the job without the job costing and stuff, especially the longer the jobs go. And if you're building a 1-month project, you probably don't need that stuff because you start it and then you finish it. But when you're in the middle of that, how do you know where you are for these monthly, quarterly reports, financials, and get some reasonably accurate picture? And I guess the only way to do it is with job costing. That's how I know how to do it.
From a bonding standpoint, you get these credit score bonds, usually up to about a $500,000. Over that, you got to produce some reports, accounting report. That's just the way it is. You have to be able to show what you're billing, your receivables, what your costs are. And these companies that want to transition from credit scoring bond programs to regular programs, they don't get how huge that gap is.
Yep.
Mhm.
I'm
And
not talking about GAAP, GAAP.
we are just talking about that. But yeah, I mean, one of the things I hear from contractors all the time is like, I run it by what's in my bank account. And in my gut, I know how I'm doing on this job. Well, your gut can be wrong. And a lot of times in your gut, your overhead factor may be something that has absolutely nothing to do with what's actually your overhead factor should be. But from a profit first standpoint, if we're going to do that, well, number one, you can get so far with putting things in the OPEX bucket, and that's when we need to start breaking it down more into materials and subs, things like that. You don't really know about what's in your bank account because it can fool you.
Also, you're not getting bids. You're just right in the middle or you're high and you don't understand how can so and so be doing this job for that amount. That's my cost. Is it really? For sure. They may be bidding it below cost, but do you really know?
I know this whole podcast is about differences in construction accounting. I don't think we're going to hit all of them today, but one of the other ones I wanted to talk about was retainage receivable because so many people treat that incorrectly on their books. And number one, when you bill on an AIA billing and they say take out 10% for retainage, and you had, say, a billing of $100,000 and they took out 10,000 retainage, well, your revenue should reflect $100,000 and you should have $90,000 sitting in your accounts receivable, and you should have a separate tracking of your retainage receivable for the remaining 10. I see people in their books, they'll show $90,000. And this particular contractor that I was talking about with the multifamily stuff, they always back that out and they wanted a WIP report. And their billing needs to reflect the entire billing that they've earned, including that retainage. Does that make sense?
Yeah, I'll see a retainage column on a aged receivable list. It makes a lot of sense.
And again, going back to the fact that you need to have that in a separate account, because number one, if you put it all in your accounts receivable column, you're going to look like you're taking 120 days or more, depending on how long your contracts go before you collect that retainage. You're going to look out of whack to your bonding companies. They're going to say, why are your receivables so high? You're not collecting any money. If they understand that retainage, if it's in a separate bucket, they understand that. If you're seeing your regular accounts receivable is over 90 days, they're going to throw it out the window because they know you're probably not going to collect the regular accounts receivable once it gets over a certain period of time.
When you see that retainage in there, and you said you've already realized the revenue, you've already put that there. Have you realized that for tax purposes, or are you waiting till you receive it to do it on tax purposes to
Well,
show our
for
results?
tax purposes, they're
Oh, this
different.
is GAAP, right? This is not
This is
tax.
this is GAAP,
This is GAAP, and that's the things we got to get straight in our head because this is
and
GAAP, and we got to remember.
that's a great example because retainage receivable. There are hybrid methods in accounting if you know how to apply it. You can do an accrual basis less retainage receivable. That's an accepted accounting method. And it's not a GAAP method. It's not anything And unless you know construction accounting, you would never know that you could do that.
So what you're saying is if we're, I guess typically they're billing, they've got the whole billing thing. It's down there. It's the revenue, but then they've got this, I guess it's an asset left over. Would it be an asset?
It is
Yeah,
an asset,
it
yes.
would be an asset, but you've already got that revenue, but you make an adjustment for your taxes on the
If you're
tax side.
on a accrual less, it's a hybrid method, but
Yeah.
if you're on accrual less retainage, yes.
Yeah. So those are a lot of basic questions that I'll get and think about when we're talking about that. So, well, I don't want to pay taxes on it. I may never receive that, and I haven't received it yet.
Yeah,
So,
exactly. And I know we're probably running out of time here. There's other things like retainage payable that kind of goes the other way, and you really got to think about those kind of things. There's,
which is
construction
liability,
laws,
right?
and we could talk about it depending on if you're getting bank. Mine are typically commercial guys, but if you're like a home builder and you're getting construction draws or something like that, they're going to have phase code, cost code kind of thing that the bank's going to require. So there's a lot of different things that we haven't even really touched on with the construction accounting, but just know that they do not teach a lot of these concepts in school, even to CPA, even
Yeah.
the advanced stuff. They don't teach this because it's it's not something that people do every day. And unfortunately, like a bookkeeper or whatever, a lot of them never learn that if they try to go to the local college and take a course. It's not out there because they don't teach it. And you got to learn it on the job or from somebody that knows these laws and from the tax side or whatever. That's why you can't just jump out of school and throw it in your QuickBooks and expect it to be right.
Those are some great points, really good points. And the fact that, after all these years, I still get it in my mind that there's sort of two sets of books. There's a set of books that you pay taxes. They're not two sets of books, but I guess it'd be better to say they're adjustments for taxes because two sets of
Yeah,
books sounds like you're doing something.
I threw that out once in one of our podcasts, and I
Yeah.
was dead wrong, and I was corrected on it. There are not two sets of books. That's just it.
Well, I know it sounds bad. And if you actually do have two sets of books, well, if that's the one you're trying to hide from the IRS, well, those are the ones you're going to jail for. So I guess on that note, we probably
Okay, good point, Wade. So one way you learn about accounting for contractors is through the Contractor Success Forum. And we've been preaching all along, you need a construction oriented accountant who does this all the time. There's a lot of tweaking that can be done that can really benefit you by the right accountant. Any other ways, Wade?
Well, again, believe it or not, I would say 90% of the CPAs out there, probably more than 90%, don't know these rules unless they specialize.
It's certainly frustrating for me to try to get bonds for uh, commercial contractors that don't get that.
Yeah.
But
All right. Well, that's great. Well, this has been very, very insightful and thought provoking. So that's the big thing is you're definitely not going to get all this in one little podcast, but it starts your brain flowing. So hopefully there's one or two points that we pick up that'll just register. It's one of these things that you have to hear over and over and over again to sink into your head, especially if you've been around for a while. If you didn't begin with the GAAP principles that we were just talking about. So this has been a great show, guys. I appreciate you coming out early this morning to get on the Contractor Success Forum. Thank you, Wade Carpenter, Carpenter and Company CPAs, and Stephen Brown with McDaniel Whitley Bonding and Insurance Agency. And I'm Rob Williams with Irongate Entrepreneurial Support System. Thanks for being here today. If you need our information, if you need to get in touch with Wade, check out our show notes or our webpage, contractorsuccessforum.com, and you can ask him some of these GAAP questions and see if he can help you. Thanks a lot. Have a great day.